Good morning. This is Ken Long from Tortoise Capital Management with a review of the weekend trading plan for February 3rd, 2013, Super Bowl edition. Markets in bullish quiet, high end of neutral on an annual basis using weekly RSI 14. Oversold definitively on a 10-day NDX basis at 108, so it closed 8% higher than its 10-day high based on the width of the trading range. The price relative to the 200-day moving average, the percent stretch, and the slope of the 50-day moving average are both coded green, bullish, very strong. ADX is now at 36.4, trending upward strongly. That's starting to get into nosebleed territory for trendiness in the S&P. Hard to sustain it above 35 in an index that large. ATR percentage is at a 6-month low at 0.66%, so that's rated quiet. The VIX index, which looks at the moving average of the 30 divided by the moving average of the 10 of the VIX, is at 1.12. That's risk-on conditions. The Z-score of that reading, looking at 5,000 days of backwardness for context, is at 1.36. Here you can see a time series of the last 30 days, how the gains in the VIX over the last few days are starting to eat away at that, what used to be well over 2. So closer to the end than the beginning of that trend of exceptional quietness, in my view. When that gets that fragile, my sense is that the potential for a sharp VIX move upwards is there. We reblended the monthly rebalancing. You can see the holdings. Next reevaluations on or about 1 March. Theoretical exposure in ETF2 is at 100%. Model portfolios at 100%. No changes this week. There's a trade of the week example of short-term trades hosted at YouTube. Quick look at the holdings in the portfolios for blended monthly. Again, still dominated mostly by the globals, but you can see mid caps and small caps in the U.S. are coming back. I think the Apple effect is keeping the spiders and the Qs down. And the same thing in the broader example, too. I would say XLF is of interest because I think that's the Fed printing money, giving it to banks who are buying equities, which is driving up the U.S. Stock market, and so their portfolios then in turn get boosted by their own cyclic buying. I have a hard time seeing how that gets sustained, but then again, I don't have to understand it in order to be able to trade it. Market health check. Vertical blue lines are 10, 20, and 30 days worth of look back. Horizontal red lines are support levels from previous excursions. Thursday, we came back and tested the edge of the river and the 10-day moving average, and it held and made it to a new high. That's why we're at 108, because it closed at a high. Thick black lines, 30-period regression line. Outer channel is formed by the maximum excursion from the channel, from the regression line. Orange is a 2-period Bollinger Band. Dark blue is 30-period Bollinger Band plus or minus 1, the river. The lighter blue is the floodplain. Red region is the 200-day moving average. So the river and the floodplain are well out of the lava. Everything pointed higher, no resistance overhead. The slope of the 30-day regression line is as high as it's been in the last 6 months. So that's powerful. It can stay overbought for a long time. If that is a support level and that was a buy on dip opportunity, could be set for another leg up of that same dimension. So we'd be looking at another $5 to $6. It's about another 3 to 4%. Hard to get much quieter and steadier than that move. Remarkably so. Could that be early January buying? Perhaps. I'm cautious about this one. I'm glad to be in it, but I'm monitoring my stops even more closely. When it's quiet, it can be too quiet. This was the end of a little run right here. You can see in the percent price oscillator, which closed and is now opened back up again to the upside. Cautiously optimistic. It doesn't change until it will change. And so that's my interest right now in the VIX and monitoring the ship here for signs of leaking. Quick look at the ETF2 regional report. Everything's on a buy, so it's all 100% invested, 0% cash. The globals are still better than the spiders. Inside the U.S., it's MDY, the mid caps, the small caps, the large caps, then tech. The two strongest sectors are Europe and then the Euro-Asia blend. Two weakest are U.S. tech and U.S. large caps. World market model tells the same story. Large caps are lagging, smalls and mids are above average. Anything Europe is good, although some of that green is coming out from up in here. You can see the individual countries still doing well. Only the UK is lagging. Asia and Asia less Japan continue to be good. Selected emerging markets are good. It's interesting that Malaysia and Singapore for the longest while were the leaders in Asia. Now they're the laggards. China coming on. In the energy complex still, that's the only place where the global business sector is lagging behind the U.S. Counterpart. Strength is in finance, especially international finance. I still think that's printing. That's printing money and shadow inflation. All that money's going right into the stock market, courtesy of the banks. Top ETF 30. Again, dominated by the European countries and financials. This one, IXG, Global Financial, could be an interesting play. The Dow 30, based on the same lens, sorted by relative strength. Bank of America, Cisco, JP Morgan, Travelers, Caterpillar, United Tech. Hewlett-Packard remains in the top third. Again, it's got the above average strength, below average total score. And again, this is the first column that changes. It tells you where the emerging leaders are and where weakness begins to occur. Caterpillar and United Tech are very interesting because they're high up here in the green, but they haven't reached the long-term goodness yet, as you can tell by the white in the average score. Whereas some of the energy is coming out of Home Depot, which was green on the average, but then is only white in relative strength. Walmart could be interesting here. It's red on the strength and yellow on average. That could be a sign of early value play, as would be Alcoa, United Health, DuPont. ETF liquidity, just for reference. We'll shift now to the daily. No signals in overreaction or channeling. You can see volatility has bottomed out. This little hook up here in volatility suggests to me that that's about as quiet as it can really get. And so when it can't get any quieter, it'll get louder. And I think that's what we're seeing here in this decay in the VIX Z-score. This run up here in the VIX quietude corresponds to this sell-off or this compression of volatility down here until it can't get any quieter. When it can't get any quieter, the next state change is something louder. That's why I've been paying very close attention to the VIX. If we look 20 years back on the VIX, and then these are today's readings. The VIX reading over the last 20 years, the highest it's ever got is 80.86. The lowest was 9.31. Today it's at 12.9. The average has been 20.69, and with a standard deviation of 8.49, that means the upper and lower thresholds of normal are 29.18 and 12.20. So we're right at the lower boundary of what would be a normal reading on the daily VIX. Right? The index in the Z-score compares the slope of the line that computes the ratio of the 30-period moving average divided by the 10, and that's at more than one standard deviation above normal, thus it's coded green. So very quiet indeed. 10-day max pain leaders. Intel, Hewlett Packard, Merck, Alcoa, American Express, VIX Natural Gas, Gold Miners, Malaysia, South Korea among the ETF 100. Those would be those are all interesting plays based on how much they've lost from the 10-day high. That's important because they are out of step with the market, which closed at a 10-day high, and yet these are the ones that have lost the most from their 10-day high. So that represents the greatest divergence from the norm. Could they be, if the market fails and these fail further, that becomes an instant short, or going along the inverse, or they are the ones that are poised to have the most ground to catch up if people suddenly believe in them for whatever reason. When that belief changes, price changes sharply because the tug of war between buyers and sellers just changed, and that sudden release of selling pressure will cause it to get bought. Channeling signal in ExxonMobil, washout pattern in Intel, 5-day down patterns in natural gas, triple screen in Hewlett Packard. That should be a very interesting play there. Pausing for the next run up. 551Ws in Cisco and Alcoa. Cisco's interesting because that's a tech leader, so you got some real good choices in there to practice framing. Auto framers, Intel, VIX, and Treasuries. So the Intel ought to be high on your list because it's good for the auto framer, good on the washout, and because technology's been lagging. Dow 30 tactical summary. All of these that are highlighted in green over here made new highs over the time periods, whether it's 10 days, 1 month, 3 months, 6 months. Whereas Merck made a huge loss and is the only one that is less than 10 on the RSI2, and it's number 2 on the max pain range compression. It lost 3.3%, and it's lost 2.5% over the last 10 days. It lost 3.3% on Friday. Therefore, the possibility of an anomaly is useful, and it has intraday only a 30-cent frog standard deviation. So that one could be interesting tactical play on Monday morning. Looking at the ETFs, only a couple dojis, 1.5 DD in natural gas. The VIX and Treasuries both test out well on the auto framer. You can see all the ones that all closed at new higher. The one that had the biggest move up, it looks like 123, and that would be, and that's financials, just been dominating. Why fight the tape? Slope of the regression line doesn't get much stronger than that. Can't get much stronger than that unless there's an asymptotic move up. It's well above, the slope of that regression line is above its 10-period moving average, and it's more than 1 standard deviation away. That's the very definition of a bullish move. You can see it's made a 1, 2, 3.5 standard deviation move off when it got the worst, which was down in here on the last test of the 200-day moving average. All systems go. Although this is as far above the 200-day moving average as it got in the last big run up when it made the previous swing highs up around these price levels. So this is a price level at which it failed before and could make that kind of a move, a 10% move. Z-scores of swing gains. I'm updating my database on this one and creating a new spreadsheet that's going to be looking at Z-scores over multiple time periods as a basis of looking for swing patterns that are statistically driven, not necessarily pattern driven. So I'm very excited about that. I was up till 2 this morning fooling around with it, and very, very excited when the intuition's working on things like that. The feelings that I get on this one are similar to other major breakthroughs I've had. So excited about where this one is heading. But for where it stands right now, you can just see how strong the financials have been, and XLB, and even Japan's made a nice move. Z-scores of regression line slopes. The 30 is strong. The 90 is rolled over cross line, and the longer-term trend has started to motor higher again, so there's still room for that to go. If it does this could be another 10% leg up in price. And this is at a good time to get it here with the 10 having pulled back. That's a perfect swing opportunity. The two longer-term trends, the longer-term trend just crossed and went positive. The intermediate-term trend, 30, is already very positive and getting people's attention. And then the shorter term had a little pullback and is poised to go higher. That's what you get in this kind of condition. That looks very, very positive. You can see price with respect to the river has cleared the support levels at 148. Still only a 3%, and it can change quickly, but until otherwise noted, that's all very favorable. That's the same chart, but now for the spiders. IWM looks very even stronger, obviously, than the S&P. And treasuries pointing the way towards higher equities, and gold still stabilizing around 160. There's some longer-term inflation protectors that are supporting that at 160. That looks like strong support because it's not failing like treasuries. That's money that is people are not selling gold. The people that could sell, the tactical traders have. That's people that there's some long-term believers in gold. I'm one of them. Statistics for context and frog stats for reference. Fail stat for reference. Signal to noise ratio for reference. Like this ExxonMobil, that was a swing pattern. 50% of its intraday movements is typically directional, so that should be of interest. Walmart also high signal to noise ratio at 0.49. And that may be the value play that we saw on the one on the tactical screen. More reference stats. All right, that's Ken Long from Tortoise Capital. Let's take a look at the quality report. I haven't done that for a while. Looking at the Dow 30 sorted by the long-term quality, and what we're looking for is divergence. We'd like to see the difference between long-term quality and short-term quality. As an example, I like to see long-term horrible, short-term excellent. That would be reflected in this column. And so you can see the number one candidate right now, and number two, McDonald's and Hewlett-Packard. We haven't been talking about McDonald's at all, but it's quietly making a heck of a move right here at 3.05. That's the difference between 30-day quality and 12-month quality. And you've already seen the strong move in Hewlett-Packard. This tells me I ought to be taking a look at McDonald's as well. Interesting. And 3M. Now, the other thing you'll notice is a lot of times the very powerful 12-month quality has short-term weaknesses, like Bank of America has been so good for so long, but it's actually losing steam in the last 30 days relative to how it's performed in the long term. So I like to catch them earlier at the turn, at the bottom, and rolling up and improving quietly, whereas this would be sort of a relative strength. You'd look for green here and then white here and then a resumption of that trend. Among the ETFs, oil, Latin America is making a strong move, and we've seen that in the charts. Among the transports, the strongest have been these. Again, you can see the weakness in UAL, though. Norfolk Southern should be of interest here. It's red long-term, white short-term, has a powerful positive divergence. Not quite as good as Kirby and Matson, but that's what I'd be looking for: red and then white. I like that. So Norfolk Southern should be of interest. All right, that's a review of the weekend trading plan and a few ideas for swing trades looking forward. That's Ken Long from Tortoise Capital. Keep your powder dry and your risk measured.